Most explanations are a bit too dramatic. This is a long-term structural move, not a panic response. How you structure your lending matters more than ever. Hey guys, in this video, I'll be talking about a major announcement from APRA, causing a shift in Australia's lending environment. Something that will impact how people borrow, how investors grow, and ultimately how the property market will move over the next few years. I'm Jai Kao, mortgage broker and founder of JD Capital and a top 50 broker in Australia. I have also successfully built over a $15 million property portfolio in the past decade. So APRA has introduced a new rule to limit high debt-to-income lending. It's been circulating through the news headlines, but most explanations are a bit too dramatic. So in this video, I want to break down exactly what this change is, why APRA is doing it, what it means for you as a borrower or property investor. So first, what did APRA actually change? So APRA has introduced a hard cap on how much lending can go to borrowers with high debt-to-income ratios. So banks can now issue no more than 20% of their new loans to borrowers with a DTI of 6 or higher. But here's the interesting part. We're nowhere near the actual limit. Right now, only about 10% of investor loans and only about 4% of owner-occupier loans sit above a DTI of 6. So APRA didn't step in because things were overheating. They stepped in before they overheat. This is normal, and this happened in the past. This is a long-term structural move, not a panic response. So why is APRA doing this? The reason is because lending in Australia moves in cycles. When interest rates fall, borrowing power rises, and borrowing power rises, you've got expansion of credit. And when credit expands, property prices usually follow. And APRA knows that if rates fall later in 2025 or 26 or beyond, demand will spike and people will start pushing their borrowing limit again. And usually the first ones will be investors. So APRA is putting the guardrails in a bit early. And this rule is designed to, 1, reduce risky lending at the top of the cycle, 2, keeps banks stable and avoids the stretch everything to the limit behavior we see in hot markets. Thirdly, it only applies to ADIs, authorized deposit taking institutions, which are usually major lenders. So it's a seatbelt, not really a handbrake. So what does this actually mean for you? Even though the system average is quite low, some individual banks are closer towards that 20% threshold, which means some lenders may tighten their lending earlier than others. And the banks known for stretching borrowing power may need to dial it back a little bit. And the sequencing of lenders become even more important for investors. So the key point that I believe is this rule doesn't reduce your borrowing capacity today. It simply restricts how much banks can lend at the extreme end in the future. So if you're aiming to build a multi-property portfolio, it's still possible, but choosing the wrong lender too early can limit how far you can go later. Now let's talk a bit about non-bank lenders. As a broker, we've got access to a range of non-bank lenders. Right now, APRA's rule only applies to banks, which are ADIs. Non-bank lenders operate completely different, and they have different servicing rules, different buffers, which means they can give investors more borrowing capacity when major banks can't. So the pathway for investors isn't closed. It just requires better planning and smarter sequencing. Now, a lot of you are probably also wondering, will this slow down the market? In the short term, I believe no. The cap is far above where the lending currently is, and from a long-term perspective, this change is designed to smoothen out the next phase of the property cycle. Even without regulation, the market is already self-adjusting with strong demand and lower supply. So this rule, in my opinion, is more just to curb the growth of credit too quickly. So what should you do now? If you're planning to buy or scale in the next 12 months, the real lesson here is this. How you structure your lending matters more than ever, because if you put all your loans with one bank and that bank hits the DTI cap, you could find yourself blocked, even though your actual financial position hasn't changed. Different lenders treat income differently, different lenders treat debt differently, and different lenders treat DTI, debt to income ratios, differently as well. Some are more aggressive than others, some are more conservative. Some specialize in giving investors more flexibility. This is why smart investors diversify their lending across Tier 1, Tier 2, and Tier 3 lenders, so they can prolong their borrowing power as the rules evolve. I actually did a video on this recently, so we'll share a link to how you can improve your borrowing capacity by using a range of Tier 1, Tier 2 and Tier 3 lenders. So this APRA change isn't about reducing your options, it's about raising long-term guardrails in the system. But it does mean one thing for sure, don't put all your lending with one bank. If you want to understand how this APRA rule affects your borrowing power, or you want a clear roadmap of which lenders to use and when, book a discovery call via the JD Capital website. We will drop the link below in the bio. As part of our process, we will review your structure, assess your capacity across the full lending market, and build a plan that helps you keep moving today and through whatever changes come next. But I wanted to share with you some of the changes that's happening from APRA, and so that you can be more informed. Thanks for watching, and I'll see you in the next video. Happy investing, and you're stronger when you have help.